David Linton, born in Australia? Yes, he's one of us. We can claim him. But he's also one of the UK's leading technical analysts and is founder and CEO of UpData. He's the author of Cloud Charts, Trading Success with the Ichimoku Technique, and teaches part of the diploma course for the UK STA. He's a member of the American IFTA and a holder of the MFTA designation awarded by IFTA. He's going to be talking today about what the charts tell us about the opportunities and risks that lie ahead. Please welcome David Linton.
Thank you, Max. Right, just make sure I've got this. Yeah. So as Max said, I'm actually Australian. I only have an Australian passport. And for those of you who live in this beautiful city, it's a delight for me to be back in Melbourne. I haven't been here for 10 years. And I was lucky enough yesterday to have the opportunity. I walked 14 kilometres around Melbourne, and boy, oh boy, it's easy to forget what an amazing place this is. So I was actually born on the Mornington Peninsula. I grew up in a place called Linton's Nurseries. If any of you ever drove down the Nepean Highway through Mount Eliza, then you might know that, and hence that's the Linton. I went to university in London. I lived in New York for a while. I'm still passionate about gardens, and this city is just great if you're passionate about gardens. I lived in New York for a while. I'm an avid sailor. I live actually in Cowes on the Isle of Wight in the UK. I ski, and the latest thing is I write travel books for a little bit of a hobby. That's the personal stuff. My professional work, I started out trading options in the late 80s in London when I was at university. I started UpData, which is a technical analysis software company. I teach, I've taught a lot of people, and I spend a lot of time at desks with clients, mostly professional clients, going through technical analysis. I live and breathe the subject. Doing a lot of research in this area, obviously a member of the STA, and I did my MFTA, which is the Master Financial Technical Analyst qualification with IFTA. My paper was on the optimization of stop losses, which you can see in the 2009 IFTA journal. And I'm also a member of the American Association of Professional Technical Analysts because I spent time in America. And who knows, I'm going to start spending more time in Australia, so I might even become a member of the Australian Association. And of course, I speak at quite a lot of conferences. I do a lot of this stuff and more online. We'll talk about that. And I wrote Cloud Charts, and I've got a copy of the book here if anyone wants to see it. So this actually is for me, just to remind me to keep true to the topic. And so I've just highlighted for myself the words, and I'm going to try and keep to that. I've got 90 slides to get through, so I'm going to fly a slide a minute. So I'm hoping you're all wide awake. So the structure is I'm going to use some key concepts. I'm going to then look at the technical analysis tool set, which we all know and love. I'm going to then look at how I combine these tools for more power, and I sort of need to get through that session in order to be able to then identify the risks that the charts are saying, and then of course the opportunities. So I just start out with a few concepts. I mean, this is really I'm hoping I'm preaching to the converted in this room, but when I'm not preaching to the converted, I nearly always say, price does not equal value. They're just two different things. And so, that's just really quite often my starting point with this subject. And if price did equal value, then we wouldn't need a market. The market is constantly trying to reevaluate what something is worth by pricing it. And who would believe, for example, this is a chart of WTI, who would believe that WTI would go to negative $40? I mean, is that even possible? But it just shows you that anything can happen and does. The big one is the trend is your friend. I've got a little, these symbols I put in the slides just to remind me to tell you this. This is a turkey. I love this saying, even turkeys will fly in a strong wind. Basically the trend is your friend. If you've been trying to short tech stocks for the last 20 years, you haven't been doing very well. You might do better now, but you haven't been doing very well. But of course, all trends come to an end. And so we do have to accept that trends do end, but the trend is your friend. And a big part of technical analysis, and a lot of what I'll talk about today, is about identifying the trend. If we can identify the trend because it's our friend, then we're halfway there towards getting it right. This is actually a chart of German power. In Europe, all the talk, in fact, I listened to the news this morning in the UK, it's last night's news, all the talk is about energy in Europe at the moment. The Ukraine crisis has created a problem, but well before the Ukrainian war was, the Russia-Ukraine war was kicking off, prices were going crazy, and all the way up we gave clients targets for what would happen to German power, and just went higher and higher. And so basically, this is the trend, and of course it's this idea that things can really go massively higher or massively lower. And really this is a big thing about where we are now, is we are going to see very big changes in markets. This is quite controversial, hopefully not so much to this audience. News follows price. So I believe that we all want to know the diagnosis. We're obsessed with why something has happened. We need to remember as technical analysts, it's not about why, it's about what. It's a study of effect, not cause. We're really not interested in why something is happening. We just observe that it is happening. The chart represents everything that everybody already knows about the market. So I always say to people, tell me something I don't know. Is it the information that's not already in the chart? And if you think back to the ticker tape, that was the news. Prices were coming through, that was the news. And today, really, what tends to happen still is you get a big move, the market's reacted, and then we all go looking for reasons why that move has happened. But generally speaking, you can't trade on news. Good news happens in uptrends and bad news happens in downtrends. And if you think about the definition of what is good news, if the price falls, even if the news was good, it's not as good as expected, therefore the price falls. So how do you define what is good news and bad news? It's basically by what the price already is, what the price does. And bad news happens in downtrends. So you just need to get used to that. It happens. This is a big one. And I've got a little thing here that says, thanks, Ralph. I was speaking at the New York MTA conference probably around 10 years ago. In fact, it was Germany 10 years ago, but several years back. And Ralph, and this is why it's so important to come to conferences like this. You just need a little gem. And Ralph stood there and said, what's the time horizon? Ralph Acapora said, what's your time horizon? Before we can have a meaningful conversation, we need to know what is the time horizon. And I put down here, listen up, it could cost you a drink, because anyone who comes up to me at the conference and says, what's your view of such and such, I'm going to say, buy me a drink and tell me your time horizon, and then we can talk. Because until I know your time horizon, basically, we're having meaningless discussions. So what's your time horizon? Then this one little gem of asking the question led me to develop this table. It's in the Cloud Charts book. And basically, this has become a grid or a roadmap that I swear by and use. And another thing is I'm pretty useless without the chart. So when you say to me, what's your view of such and such, unless I've got a chart and one that I can actually read, I'm probably not going to have a strong view. I know what the big moves, I know what's happening when I look at the big things, but in terms of going down to smaller detail, I need the chart. But basically, this is a matrix that you need to use. So medium term is what I call a daily chart. And if you think about it, a daily chart, the price on the end of the daily chart is changing all the time. So that chart is actually not strictly accurate until the close. And I would say when I've gone to desks and I've talked to traders, the number one thing I've noticed is that they're using the wrong time frame chart to make decisions. So you can't decide what is going to happen tomorrow on a daily chart. It's just not going to help you. If you think about it, you need a lot of data points going forward to be able to do that. So you want to look at a 60-minute chart. If you're thinking, I want to know what's going to happen over the next few months, well, a daily chart is probably just too granular. You go to a weekly. So, and then of course, people have different definitions of what's short-term and medium-term. Depends on if you're a trader. I was seeing clients in Dubai at the start of, where are we? At the end of last week, I was seeing clients in Dubai, and they said we're short term, and I said, well, what do you mean by that? And they said, well, we get in and out in a handful of minutes. I said, well, what would you define as medium term? And they said, oh, today. So everyone has different time frames and horizons, and everyone I work with, we just get into this habit of saying medium term is the daily chart, and short term is intraday, like 60-minute chart, and then very short term I go down even to 1-minute charts, and then long term I go to weekly, very long term monthly, and I even use quarterly charts, so that's ultra long term, and we will look at some. So the easy way to remember this is days means weeks, weeks means months, hours means days. That's really key. So you will see this throughout the presentation, and I put a little gem down the bottom there because basically this is a little gem for you today. So the technical analysis toolkit, and I talk to a lot of traders and investors who use technical analysis, and I say it's great to know it all, and it's good to have a great knowledge of the whole subject, but you don't have to use it all. Just open the toolbox and say, what job am I doing? Which tool do I need? You don't have to use it all. So where do you start? So, there's lots of different chart types, and we'll look at some. I'm going to specifically talk more about what I use, of course. There's dozens of chart tools. My programmers love these fans and arcs and circles. They just think this is fantastic. Anything that's new, they want to know about trying to program it. But can you really use it? And then indicators, there's hundreds of these. Which ones do you use? Which ones did you choose? And then trading strategies, well, we've got over 1,000 built into our software. So again, where do you start? I mean, the subject has got just bigger and bigger and bigger and more complex. So where do you start? So this is what I use, and I put some cherries here because I think it's right to cherry pick. So all the time I use Dow theory, I use key price levels, resistance and support, price patterns, and the two that I'm going to spend a lot of time on today is cloud charts and point and figure. So I use these, and I'm going to have to give you a little bit of a lesson because we can't do anything meaningful analytically until we have some understanding. Occasionally I'll use relative strength, I'll use on-balance volume, candlesticks, trailing stops. I did the paper on that, obviously, and some of the other things, seasonality, correlation, market profile, oscillators. I'll use these things occasionally. I almost never use Elliott wave. I just find it's just too subjective. Don't use swing charts. Moving averages I barely use. I find they're too slow, and a whole lot more, obviously. But I think the key thing about what I like to try and do is I like to use objective techniques and interpret them subjectively, which is point and figure really, rather than Elliott wave, which is, I think, a subjective technique that you then try and interpret objectively. So I like the rules of the technique, and that's a big part of it. So in terms of the things I use occasionally, if I'm looking at a stock that's going sideways, quite often I might look then at an oscillator, but I'll certainly maybe look at the relative strength. I'll look at the on-balance volume. Is that breaking higher? Is that giving me a clue as to which way we're going to break? So, these things have a value. I work with quite a few funds. I consult to them, and quite often when we're looking at their holdings, we will basically, if we're trying to work out what's going on that we can't quite see on the price chart, we'll defer to these things if we're not getting the information we need in other places. I like to flip charts. This is actually a chart of silver. It's actually silver turned up the other way. Actually, silver has just recently popped, so we will have actually seen this trend just break. It's been quite interesting. But this is quite an idea. You can just flip your chart up the other way, and it helps you deal with any bias that you have. It plays with your mind. So it's quite a good thing, again, if you're just not quite sure, flip the chart up the other way and look at it the other way up. This is silver in an uptrend, and there's a lot of silver bulls around, or precious metals bulls around. There's silver in an uptrend. This tells us really that it's been in a downtrend. This picture has actually changed a little bit. Oscillators. I mean, there was a time, when Wells White's book came out in the 70s and the 80s, we're all reading, and as computer programmers, we're spending our lives programming oscillators, and it was great. Second order indicators and derivatives of the price. The problem with oscillators that I find is they give you too many of the wrong signals. By that, I mean, in an uptrend, you're going to be constantly told you're overbought. It's overbought in an uptrend. And in a downtrend, you're going to be constantly told that it's oversold. So you get too many of the wrong signals. In fact, on an RSI might not even hit 30. You might not even get the buy signal in an uptrend. So the problem with indicators is that they are skewed towards the trend. And so they don't really work very well in trends, is my opinion. You can shift your levels higher, sure. But realistically, they are biased towards the trend in the wrong way in terms of how you want to trade. They work great, though, of course, in sideways markets. So if you're stuck in range-bound markets, that's when indicators come into their own, because they will give you sort of equal buy and sell signals. So that's another little gem. There's a little gemstone at the bottom there. Indicators work quite well in sideways trends, but they do not work very well when you're trending. So we're seeing a lot of things starting to fall, a lot of downtrends. You are going to get lots of signals telling you it's oversold. Which is not really what you want in a downtrend. You don't want to be told to buy in a downtrend. Dow theory, it's the bedrock of technical analysis. When I deliver training courses to clients, and I spend a day where I'm going through the whole subject and teaching them, they quite often say to me, look, can we just do without the Dow theory? We don't really need the Dow theory. I say, no, you really do need the Dow theory. And what often happens is throughout the day, we realize that the Dow theory just comes back through everything we do. So most charts are in a situation where we've pulled back and we've found a floor and we're stuck in the middle, or we've come down, we've recovered, but we're sort of stuck in the middle. And are we going to break A or are we going to break B? We're dealing with a pullback or recovery. The instances where this is not the true is all-time highs and all-time lows, but we don't see those a lot. So most of the time, this is what we're looking at. And don't forget the basics. The basics of technical analysis is, where are all the buyers positioned? I love this one. People buy at A, the price goes to B, then at C, people are prepared to pay more for this asset, whatever it is, we don't care. This chart could be a 60-minute chart, could be a weekly chart, we really don't care. People at C are prepared to pay more than they were at A. That's all we need to know. These people are now willing to pay more for this than they were previously. Then we come to D, and at D, people sell at the same place that people did at B. And so the interesting thing is, what's happening at D? You got people who bought at A say, I should have sold at B, I'm going to sell this time. You got people at B who say, oh, thank God it's come back to where I bought it, I'm getting out. And you've got the smart people who bought at A and sold at B and bought at C and said, this worked last time, I'm getting out here. So these are the emotions that are actually contained within the chart. And it's easy to just forget this, but this is what happens. And of course, then we break higher, we pull back to E. Oh, there's 3 points, we can put a trend line on there. By the way, more and more people using technical analysis, the more people spot the trend, the more we're getting close to the trend ending. So once you can see the trend and it really becomes very clear, you start to reach a point where the trend will probably soon come to an end, because everyone's got it, everyone's spotted it. We break to a new high. Fantastic. The people at B and D didn't sell at this level this time. This is going to the moon. This is amazing. And then it pulls back to G. Yep, hits the trend. We know all about how the trend works. Buy here. And then something really strange happens at H. For the first time on this chart, people are willing to sell at a lower price than they were previously. So that's a whole new ball game. Previously, people were prepared to pay more than they were before, and now they're prepared to get out earlier. They're prepared to sell it for less That's the first warning sign. It's not the end of a trend. This is the point of Dow theory, but it's the lower high. It's a warning to us. Then we fall through the trend. Well, that wasn't meant to happen. And then we fall through the level that people were buying at G. So think about that. People bought at this level previously, and now they're willing to let it fall further before they buy. This is kind of what's probably going on in the housing market. You know, I mean, we're starting to see where people are not paying prices they were previously. And then we go to I, and that's, of course, what Dow coined as the lower low. Now, I know this is the most basic thing for me to tell this audience, but it's a really good thing to be able to articulate this so that when you talk to others, you get it. Patterns, again, it's just about where are the buyers and the sellers. You know, the key thing here is, you know, at resistance, the price comes up, the bulls buy, and then the bears come in, and the bulls say, no, you're wrong, and they buy again, and the bears say, no, you're wrong, and they sell off, and then the bulls say, no, we're buying here, and then we break our consolidation pattern, and the bears were wrong. The bears have to sell because they're now nursing losses, and the bulls don't need to sell. So that, you know, this is really, and then on a, you know, looking at a reversal, the bears are sellers, the bulls say, no, you're wrong, the bears say, no, you're wrong, and then the bulls win. And at that point, when the bulls win, the bears all the way down there have got to start thinking about reversing their position. So it's really just about where people in the market are based, and that's why flat levels are really key. So cloud charts. I'm going to just talk a little bit about how they're constructed, how to interpret them, and we're going to use them in looking at what's going on in markets. I first learned about these at the IFTA conference in Madrid. I think it was 2004. That's a picture of the Madrid post office. And I've put thanks, Rick, because Rick Bensignor talked about these at the IFTA conference in 2004. And I think it's important in our subject to always attribute where you pick up your learning and where you pick things up from. So I'm indebted to Rick. He did a presentation like this, talked about cloud charts, and I went on to research the subject. I spent many years saying to Rick, are you going to write that book? He said, yeah, I'm on it. I said, Rick, are you going to write that book? He said, yeah, I'm on it. And then I said to him, Rick, you know, you've had 6 years. I've got to write a book on this. He said, fine, go ahead. And I'm happy to say he recommends the book. So, but it's interesting to put this into perspective of where this happened. So if you think about it, candlestick charts, of course, go back 250 years. So when people say technical analysis is a new subject, they say not in Japan, it's not. And then we had Dow. I mean, you know, we're talking now, you know, well over 100 years ago. In the 30s, Geisha Hosoda invented the Ichimoku chart. And I can only surmise, and I talk about this a bit in the book, that he had a team of human backtesters to arrive at what worked. Of course, then we had more and more protagonists in the US. Hosoda actually published a book on this and he told people then he had limited the technique to only telling a handful of people, and then he made it more public how these charts work. No one was really using them. I mean, you've probably seen these charts more and more around. That's probably a lot my fault. But basically, these charts have only really become known about more recently. So I embarked on a mission. I went to Japan a few times. I basically bought all the books. If you go into a Japanese bookshop in Tokyo, it's quite hard to find the book you want if you don't speak Japanese. But one of the things you realize when you get these books translated is basically Japanese doesn't map brilliantly to English. And so there's lots of ways to interpret the subject. So I've done my best through translations, and I've had a few translations done to arrive at a middle ground of what the subject actually means. Now, these are the chart elements. You look at this chart and you go, oh my God, that's really complex. There are all the Japanese names. I talk about them in the book, but really I don't use the Japanese names. Even I forget what the Japanese names are sometimes, so I use the English ones. The construction. So the turning line is what we call a midpoint, and basically that's constructed. Oh, go back. Oh, yes. So the turning line is basically the 9-bar midpoint. So the interesting thing is we use the high and the low. So if you think about how a moving average is constructed, you lop a day off at the beginning, and this is all on close prices or close of bar prices, and then you take the one at the end. Whereas the Ichimoku average, we look back 9 bars and we take the midpoint. And I like that because that's the middle of the trading range over the last 9 bars. And that's the standard line. And then we do the same, so that's the turning line. For the standard line, it's a slower average. We look back 26 bars and we plot the midpoint. And so then what we do to derive the cloud, so this average, we take the midpoint of those 2 midpoints and we shift it forward by 26 bars. And that's what I call the midpoint of the midpoints. So this is the beginning of constructing the cloud. And then cloud span B, we take the 52 bar average, we look back 52 bars. In terms of the high and the low, we spot that midpoint and we take the middle of the high and the low. So it's the middle of the trading range, and we shift that forward 26 bars as well. And then there's this thing called the lagging line, which is the price, which we shift back 26 bars. So this seems all very strange. It's really one of the only techniques where you shift forward and you shift back. So this sideways translation. So I've just stuck on this slide because 9, 26, and 52 are the periods. These are the periods that Hosoda arrived at. Back in that time, there were 6 trading days in a week in Japan. And so I can only guess, and I'm really guessing, that he came to the conclusion that 9 bars, well, a week was too short and 2 weeks was too long, so he plumbed for a week and a half. 26 bars was the number of trading days in a month, and 52 was 2 months. And of course, that's quite handy when you're looking at weekly charts because 52's a year. So should you change the periods? You can, but it doesn't come to anything. And I've shown in the book, you don't get any advantage by trying that. So that's the lagging line. We shift that back. And so these charts start to become, this is the cloud. And so what I love about this technique is it's just very immediate. I know very, very quickly if we're bullish or we're bearish instantly. Are we above the cloud or are we below the cloud? It's just a mechanism. So when we're above the cloud, we're bullish. When we're below the cloud, we're bearish. It's just a trend identifier. So what if we're in the cloud? Well, if we're in the cloud, that's determined by the direction in which we entered the cloud. So if we come into the cloud from below, we're still bearish. If we come into the cloud from above, we're still bullish. So coming in from below, that's resistance. Coming in from above, that's support. It's a concept we should all be very familiar with. So what's interesting is that price goes through the cloud first, and then the lagging line will follow. So generally speaking, the price is the warning signal and the lagging line is the confirming signal that we've gone through. And it's quite nice to have that warning that things are changing and that I need to be careful. And then when the lagging line does it, then we are confirmed we're in a new trend. By the way, this is effectively trapping the Dow lower high, lower low, which is why it was important for me to show you that slide. This is effectively trapping the lower high, lower low. So it's the conundrum of technical analysis, risk reward. The price will be earlier, but it's more risky. You'll make more profit. It's earlier, but more risky. The lagging line is later, but safer. Just kind of what person are you? I personally I would rather less signals, more reliable ones, to give up a bit of profit to know that things have really changed. But that's personal. You can actually look back and decide which ones work best. That's another thing you can do, and I talk about that in the book. You do get temporary breaches. You'll get island reversals. The candles all work, by the way. You'll get island reversals. And of course, with an island reversal, you don't know until the following day whether you've got an island reversal, so you often have to wait to know what pattern you've got. So I tend to use a 3-bar rule. I want to see we're through the cloud for 3 bars. So if you ever watch any of my commentary, I'll say things like, if the S&P is at this level or lower for the next 3 weeks, we are in a new paradigm. You can use the turning and standard lines but I don't use them very much for the same reason that I don't use moving averages too much. They're quite slow. By the time you're told, this is when you've gone a long way higher than the cloud, you might want to use them because you feel that we've gone too far from the trend. But there are other ways of dealing with this. So I say to people, clouds are a roadmap. It just tells you what you should be doing. You know, I should be going long, I should be going short. It's just a roadmap. They don't work very well in sideways markets for the same reason why moving averages don't work very well in sideways markets. So if the clouds are becoming noisy, then indicators might be the place to look. But you use the patterns. So when I see this descending triangle at the top, on the top left here, when I break lower out of that, that's then telling me that the cloud is going to work for me. I'm below the cloud. I then cross up through the cloud. I go into a consolidation range. Whichever way I break out of this consolidation range is going to tell me then where I am again with the cloud. So you have moments where they're not going to help you very much, and then it all becomes clear again. So why do cloud charts work? This is down on the bottom here. That's a cotton harvester. There's a saying, top pickers and bottom pickers become cotton pickers. I couldn't actually find a politically correct picture of a cotton picker, so you've got a combine harvester. But basically, it's just a mechanism. We're pulling the price forward and apart on each other, and what that tends to do is it tends to keep the crossing points keener towards the bottom and the top, because you're not waiting for the roll to happen that you would with a moving average, by which time it's too late. So by doing that pulling apart, you're just getting signals that tend to be nearer the top than the bottom. And basically, I have a theory that that cotton adage is basically you can't spot a bottom or a top until it's happened. It's a retrospective thing. So, at the bottom, when prices have gone off the bottom, most people start to become quite religious, and they say, God, if you could just take it back to that price, I promise I will buy at that level. And at the top, people become very religious. God, if you could just get it back to where it was at the top, then I promise I will sell next time at that level. So if you find yourself saying, I should have bought there, that's a buy signal. And if you find yourself saying, I should have sold there, that's a sell signal. You just got to follow the trend, and you can only really tell tops and bottoms retrospectively. Just an aside, this is since the book. If you've got the cloud flatlining, that means that you've got a dominant high-low because the calculation is not changing. That means you've got a Fibonacci retracement there. You've got a fib level if basically the cloud is flatlining. So it just tells you that, and you may not see that so clearly, but the cloud tells you all sorts of things. The more you use these, the more you get used to them. So it is the morning, and it's the first day of the conference, so I want a little bit of participation here. So who thinks this is an uptrend? I got one hand. Two hands. Only two people. Who think it's a downtrend? I've got many more hands. Okay. It's both. And this is the dichotomy of charts. As I said, it's only at an all-time high or an all-time low that you haven't got that scenario where we're in a pullback, or basically nearly all charts have got at least two trends going on at the same time. And quite often more than two. And so, once you can resolve this, it becomes really valuable. So remember that multiple time frame analysis. Basically here, what the cloud does, because it extends forward, it gives us an idea of what has to happen to stay in trend. And so on a daily chart, the cloud extends forward 26 days. So that's a month forward. And on a 60-minute chart, it's a few days, I say a week. And then on a weekly chart, it's 6 months. So, the cloud actually gives us some thinking of what's got to happen to stay in trend going forward. So medium term, we're thinking a month when we look at that cloud. We're thinking weeks to a month, and that time frame is a month when we put it, at a fixed amount of time. And then on a weekly, we're thinking 6 months, etc. So what's your time horizon? So here we've got a monthly, a weekly, a daily, a 60-minute, a 10-minute, and a 1-minute. What's this telling us? We're bullish on the monthly. This is the S&P, by the way, and it was a little while ago. The weekly is now below on the S&P. The weekly, we're just above. The daily, we're just trying to get back above. The 60 minutes not looking great, the 10 minutes not looking at all good, and the 1 minute we're bearish. So if you said to me, what's the S&P doing? I say, what's your time horizon? If you say, I want to know today, I say, well, let's take a look at the 60 minute and the 1 minute and the 10 minute. If you said to me, I want to know what's going to happen in the next week, I say, look at the 60 minute. If you said to me what's going to happen in the next month, I say, let's have a look at the daily and the weekly. You've got to be able to use these time frames. And it's the big advantage that we have as technical analysts, because if you think about it, fundamentals just can't do this. Talk to fundamentalists about what's going to happen today, next week, next month. Have that conversation. It will be an interesting one. You need to be at the bar for that. So basically, technicals have this unique ability. We use the tools, we change the time frame, we change our time horizon. It's one of the most powerful things we've got. So looking at techniques, using two techniques, and this is just metaphors as to why I use two. So two opinions, two heads are better than one. If they line up and they agree, that's really cool. Different ideas point to the same conclusion. So, again, that's, really a reason to use two if you're getting the same answer. I like this concept of standard deviation. One standard deviation tells you 68% of the data, two tells you 95%. It starts to get marginal. And 3 times is 98 to 99%. So really what we're saying is if you just use two techniques, it's the Pareto principle. 20% of the work would produce 80% of the result. So really, two techniques is probably all you need. Using a third technique, there'll be times where it might help a little bit, but on the whole, one technique is going to be just above half good. Two techniques is going to get you 95% of the way there, and 3 techniques is not going to give you very much more. So I just like to marry 2 techniques to just give me that edge. So I now want to talk about point and figure charts. I've got here, thanks Jeremy Duplessis, I worked with for many years in the UK. He wrote the definitive guide to point and figure, very well known in the UK, and probably many of you here have heard of him. He wrote the book. I proofread the book for Jeremy, and I probably need to go back myself and reread the book, because it's weighty and there's a lot to it. But I've again just cherry picked out of the book. So I'm going to talk to you a little bit about the theory and the construction, the interpretation of the trend lines, and how the targets work, because the targets is the really big thing about point and figure, and just some of the differences in the techniques. But basically, what I'm trying to do here is give you enough that when we start to look at what's going on in markets, that we can actually understand it from what we've just learned from the techniques. I get traders all the time, so tell me in a minute how these targets work, and I'm about 30 seconds in and they've already just started looking at another screen and glossed over. People don't want to read books anymore, they just want it now. So this is a point and figure chart. The main thing about a point and figure chart is it doesn't have a time frame. There's no time scale. The X scale is actually reversals. And this is what makes them quite difficult for a lot of people. It's the odd-looking chart. In the 1980s, when I first started doing technical analysis, I had all the tools and the charts, and there were point-and-figure charts, and I went, no, I'm not going to use that. That's not a chart I really want to use. I wish I had not made that mistake. But it's the odd-looking chart, and for that reason, a lot of people don't want to use them. The main features is that they're typically shown as X's and noughts. Some of the one box you can just have X's only, but they're typically X and noughts. There's no time scale, as we talked about. The X-axis is reversals. When we get a column reversal, we move to a new column. I'll explain that in a minute. The X and like noughts and crosses is the price interval, the box size, and this is defining the time scale. And then you've got 1 box and 3 box. I really only use 3 box. Jeremy would kill me for saying that, but I only use 3 box. And it's an asymmetric filter, so we need 3 box reversal to reverse the trend and only 1 box to go with the trend. So the targets are objective. The trends and targets are all objective. On my system, I can press a key, it puts all the trends and targets on because it's a rules-based system, an objective technique that I then interpret subjectively rather than the other way around. They were developed over 100 years ago. And basically, you imagine the ticker tape's flying through and there's just too much information here. And so the ticker tape is flying through and you're going, it's just whizzing through, and you don't have computers. You've got a pad, and if you're going to try and report every price that's coming through on the ticker tape, your pen's going to be on fire. So basically, they just go, right, well, I'm going to wait until this price has a new, if it's at 8, I'm going to wait till it's 9 before I put a new thing. And so it became a shorthand that they could do on the back of a cigarette packet. Remember those cigarette packets? They'd do it on the back of a cigarette packet and they could record the shorthand. And then they realized as I was writing all these numbers, actually, they could just have a grid of numbers and they could just write noughts and crosses. That would be even faster and it would make the chart a little bit easier to read. So it was a noise removal technique when needs must, basically I can't record all this data. I don't have a computer to record every single price change. And so that's how it was developed. So I cherry pick this. There's lots of different ways. If you read Jeremy's book, I think it's about 600-700 pages, he'll take you through the whole subject. And because of that Pareto principle and me wanting just to cherry pick and use the things that will give me most of what I need, I don't use the 1 box, I use 3 box. That tends to be the more popular. Tick charts were the original method, but we don't have tick history going back, because what used to happen is you record the change, you didn't record the ticks, you just recorded the change. You can use high-low charts, which will get you around that a little bit. I won't go into too much detail, but 1-minute charts will be close enough to tick. You won't have enough history then to go back a long way, so then you use 60-minute and then daily. Log scale is another thing that you can do where the box sizes vary as the price goes up, and I'll talk about that. But I use 3 box, daily close, 60-minute and 1 minute. I don't use weekly because the point and figure, the filter is the box. So all I need to do is increase the box. I don't want to lose that information in terms of constructing the chart. So the normal principles of technical analysis apply. We look at resistance, we look at support. These we use the same principles of where the support and resistance levels are. You can use manual trend lines where you can draw a trend line on the chart manually, but the 45-degree lines are really, so they're defined off a low or a high, and they define the trend. The buy and sell signals, and these are the 3 box signals, are coined a double top buy or a double bottom sell. So if you imagine a double top buy, the price goes up, it pulls back, and then it breaks higher by at least 1 more box. So that kind of helps me with the 3-bar rule. I don't have to wait for the 3-bar because the box, the extra bit has given me enough to know that I've actually gone enough higher to actually break out. And the double bottom is where we fall, we recover, and then we fall lower, 1 more box. And these can be all parts of a bit bigger patterns. You could have a triple bottom and triple top. It's a little bit confusing terminology because, of course, we call double bottoms and triple tops and triple bottoms something different when we look at line charts. So that's why I always put the buy and sell after when I talk about these signals. So it's double top buy is actually a failed bottom, if you like, and a double top sell. A failed top, and a double top sell is where we've fallen and we haven't recovered to make the double bottom, so it's a failed one. So it's a little bit confusing. If any of you are teachers or teach the subject, it's something you want to point these things out. So the point and figure breakout, it's the setup. This is really what's going on when you look at those patterns, and that's that extra box. And you need at least 3 boxes of a pullback to change column to record that down column. So it's defining what a pullback is, and it's defining what a breakout is. So you actually need to pull back by 3 boxes, and then break out by 1 box, and the same. So that's the little gem. This is, this is a breakout. That's why the little gem is down there at the bottom. So these patterns become really key. It will become clearer. So back to the multiple time frame analysis table. This is getting bigger. So with the point and figure chart, remember with the clouds, we're looking at changing the time frames of the charts for our time horizon. Here we're looking at changing the box size for our time horizon. And so this is really quite neat because I've got 2 techniques. I change them different ways to arrive at time horizons. So a 1% size, and you can use an arithmetic 1%. So if the price is at 100, you'd use 1 as your 1 box. Or you can use a percentage. So at 1 you're using 1, and at 200 you're using 2 rather than 1. There's a lot to try and get through in the time that I've got allotted. But basically, it's that what box size should I be using? 0.5%, 1%, and that's around the area that I want to be using when I look at box sizes. So if you're looking at something that's priced at 100, you might use a $0.50 as the box size. You might use $1. If you want to go shorter term, you might use 25 cents, but you probably want to start looking at it on a 60-minute chart rather than a daily chart, because you want the granularity of the data that's in the 60-minute chart to come into your point and figure chart. So different time horizons. So these are the different box sizes. I can't quite read them on the screen, but I think it's probably a 1%, 0.5%. And as I go down in box size, you'll see where the black line is, there's nothing to show. Then I go down in box sizes, I get new data coming in. I go down again on box sizes, I get even more data coming in. And then I go down to a really small box size. And all of that data is actually in the top left-hand chart not shown because the box size is not big enough. So this just highlights that changing the box size brings more information into the chart. It might bring a lot of noise too, but basically that's how the charts work. The trend lines. So the 45-degree trend lines, it's actually not from a top or a bottom, it's from really what we know as an extreme point. So if you look at the top here, that wasn't the top, but it's the most extreme sort of top to the right, and the 45-degree line will automatically draw from there. And what's interesting is the trend is defined as 5 steps forward, 3 steps back. That's an uptrend. And then 5 steps forward, 3 steps back. And 5 and 3 are quite important numbers in technical analysis, aren't they? So 5 steps forward, 3 steps back. If we're not going 5 steps forward, 3 steps back, we can go more than 5 steps forward, 3 steps back. But if we're going 4 steps forward, 3 steps back, we're not in an uptrend. And so that's where the 45 comes from, because you've moved forward by 2, and the difference between 5 and 3 is 2. That gives you the 45-degree line. The great thing about this is in downtrends, you tend to get lots of double bottom sell signals. So you get the signals that you want. Every time we break lower, that's giving us a new signal. We're getting signals in line with the trend. And you'll get fewer counter trend signals. Very few. In an uptrend, every time we break higher, that's a new buy signal. We've broken higher. We've broken above the last high. It's just Dow theory embedded in the chart. We've broken above the last high. We're getting buy signals. So we get sell signals in a downtrend and buy signals in an uptrend. It's so nice to be talking in a cricketing nation. I walked around the MCG yesterday. That photo of Shane Warne, the sort of modern matador of sport, and just think we are literally not quite a cricket ball throw from the MCG, but we're very close. So targets are about thrust. So if you're on the outfield of a cricket pitch, I have to talk baseball on America, but if you're on the outfield of a cricket pitch and you want to get that cricket ball to the wicketkeeper, you have to put your arm right back here to be able to go and throw it a long way. So it's the same concept here, that if that initial thrust off a bottom is big and uninterrupted, because that's what the point and figure is, It's an uninterrupted buying thrust where it doesn't pull back. We don't get the 3-box reversal. It just keeps going, going, going. It's an uninterrupted thrust. The bigger that thrust is, the bigger the resultant will be. So that's really it. So if you imagine, if you pull your hand here, there is no way from there that I can get the ball to the wicketkeeper from the boundary. Just no way. I've got to be able to go right the way back here to give it something. It's a similar concept. The size of the thrust, the scale of the thrust is what gives us the target. And then, we have the first thrust, we have the pullback. It has to be a minimum of 3 boxes. Then we have to break out by a minimum of 1 box. And then the thrust potential, and these targets were developed nearly 100 years ago. I mean, this is an old technique. Basically, that's giving you the thrust. And the resultant is about 2 times the initial thrust. That's the 3-box. That's where it comes from. So the resultant is another 2 times that initial thrust. So this is the risk-reward conundrum. You're giving up that initial thrust, but you are getting the resultant. That's another gem, by the way. So activation and negation. So you'll get a target off a thrust, but it's not activated until you get the 1 box higher on an up target. You need to go 1 box more on a down target. You need to go 1 box further lower to activate the target. So the target is there, but it's not activated until you go higher. So think about it. You've had the thrust, you've pulled back, you've got a target. But that target doesn't really mean anything until the bulls confirm that we've gone above that level where the target was locked and we're now moving. So activation is absolutely important. And people say to me all the time, that target, I say it's not activated. It's not active. We've got to get above that level to then say the bulls have won and we're now going higher. It's there. It's a signal that it's coming, but we've got to wait for the activation. Negation is where we move below the base at where the column was actually activated. So think about that. We pulled down to a low, we pulled back, we pulled back, and now we go below the bottom where that happened. What does that tell us? It tells us that actually the bulls were wrong and the bears actually are pushing this lower. So that target actually comes off the chart. It's negated. So it's a really critical thing, and it does happen. It's not foolproof. It does happen. Targets do come off the chart. Typically, if they're activated, they'll have less chance of doing that. If they're not activated, it can easily happen. So the activation part is really important. The negation is when you move above where the setup started. So it's this scenario. We run up. This is a chart. I can't remember what it is. Oh, this is European gas. I'm looking at energy a lot at the moment. I've got a lot of clients in energy as well. But looking at it, basically, we go to the top, we pull back, and now we're in the middle somewhere. It's this situation on the right here. I've got to wait for that target to be activated. Notice how the previous targets have been met. And that's what we call bullish confirmation. If the targets are met, that's bullish confirmation. If the target's not quite reached, that's bearish on an up target. But that's bullish confirmation, and we break higher, then we activate that target. So we're waiting for this. This is what we're waiting for. You get clusters. So these are downside targets where you get 2 columns. You can get 2 columns or 2 different box size charts pointing to the same level. I did an analysis earlier this week for clients in Germany on German power, and I had 20 different price targets on lots of different charts. And I said, basically, there's 20 targets, but of those 20 targets, they line up at 3 main areas: short term, medium term, and long term. And these are where these targets are lining up. And so if they line up and they point to the same area, that's what we call a cluster. And that means that you've got more likelihood of that target area being met. So it increases the validity of the target, or the probability that the target will be reached. So here we've got 3 downside targets where we've got the trend down. So this is looking pretty likely that we're going lower. So I mentioned if targets are met and exceeded, that's bullish confirmation and up targets. If they're not quite reached, that's bearish confirmation because we didn't quite get to there. So the bulls ran out of steam. We didn't quite get there. That's bearish confirmation. That's information. If we exceed them, this is even more bullish than we thought. If we don't get there, this is not so bullish. Downside targets similarly. So if we've got downside targets, this is thrusts off highs. So upside targets are thrusts off lows. Downside targets are thrust off highs, little mini highs, give us a new thrust column. If we pass the downside targets, that's bearish, that's more bearish, that's even more bearish than we thought. If we don't quite get there, the market is just a bit more willing to buy at these levels, so that tells us it's not as bearish. No, not as bearish rather than bullish. It's not as bearish. So we talked about that. So suddenly we had these upside targets that were reached, and we got new upside targets, but now we've got a new down column that's going to give us. By the way, you can't count this this big down column on the right here. I'm just for the people who are watching online. If you go in about 4 columns, that big down column from the end, we haven't got a target because it's not a thrust off a high. It's the second thrust. It needs to be the first one. And so, but we have got a new one brewing here. So that's bearish confirmation. And we're starting to see, we didn't reach those targets. It's starting to look more bearish and the trends are bearish. And again, downside targets not reached. And then we start to reverse and we've got new upside targets. So log scale I use for very long-term charts, prices that have moved dramatically or both. And so if you were to use a log scale chart on a line chart, that's a perfect candidate for using it on a point and figure. I also use it for, you're comparing apples with pears. If I'm just using the same percentage log on all the charts that I'm looking through, I mean, anyone who watches, I do chartstoday.com, and I in 5 minutes I'll rattle through probably, I don't know, 400 or 500 charts. I mean, I fly through charts, and I look at easily 1,000 charts a day, and haven't yet today. But there's not much to look at because market's not open where I live. But basically it normalizes what you're looking, and it just saves irregular box sizes. So I use the percentage charts a lot. So this is my typical screen. Up on the top, I've got a weekly cloud, a daily cloud, and a 60-minute cloud. I've got a 1% chart, a 0.5% chart, and a 0.1% chart on the 60-minute chart. So I'm just constantly talking this language: long-term, medium-term, short-term, long-term, medium-term, short-term. You got it yet? Long-term, medium-term, short-term. It's just constantly this language. And everything I do, I try to preface it with, that's the long-term, that's the medium-term, that's the short-term, because I don't want people to get confused. And so basically, we're bullish on the long-term, we're bullish on the medium-term, we're bearish on the short-term because we're below the cloud. And the point and figure targets are up on the long term, not so good on the medium term, and down on the short term. They're confirming. But you'll see now I'm bringing two techniques together. This is the whole point, is I'm bringing the two techniques together so that I can start. It's complicated. I'm using model timeframes. Bringing the two techniques together gives me this kind of matrix. Two things happening on the long, medium, and short term across 3 timeframes. So it's a 2x3 matrix, if you like. So when I look at something, I'm looking at 6 charts minimum. Sometimes I'll have another chart which is just the on-balance volume and the relative strength, just to confirm, and I'm glancing at it, and I'm flying through these, and I just go down the list and they all change. So when I look at something, I'm looking at 6 charts typically to arrive at a view. So we're now starting to think about what's going on. Because saying thanks, David, thanks for the TA lesson, that's been great, but I know about technical analysis. Well, I just had to tell you this. I know it's all been said before, but I need to say it anyway. I need to tell you all of this so that we can actually use these techniques to justify what I'm seeing in the markets. So late 2022, late 2021, I kept telling everybody, I kept saying that 2022 would be the year of the US dollar. And we were just crossing on the weekly, we were above, we had targets, big targets, and all the things were crossing on the charts. The dollar was just looking so strong on the charts. We had upside targets. We were crossing on the clouds, and we're up now 20% on the US dollar. If it's the biggest asset class in the world, and by the way, this is a metaphor for everything that's going on in financial markets. Really, what's happening to the US dollar. It's just gone crazy, of course. For what must be the biggest asset in the world to move 20% in 9 months, 10 months is just phenomenal. But it's happened. It was on the charts and it's happened. And this is actually charts from. This is a slide from a presentation I gave in Milan at the end of November. So when I write the reports, and I write reports using the charts, and mostly I just press a button and it produces the charts, and then I just write some commentary. But I can do the analysis in seconds. It takes ages for me to write it up. It's the time it takes to write it up. But basically, if I'm producing reports, I produce a monthly global markets report, and for that I'm using weekly charts. I'm using daily charts and weekly charts. So I'm thinking about what's happening in the weeks and months ahead for a monthly report. For a short-term view of what's happening, days, I'm using 60-minute charts and daily charts, and I use those for my reports that I write at the start of the week. And then for today, so every day I write a report for clients, mostly in energy, because that's where a lot of our clients are. I use a 60-minute cloud chart and 1-minute point and figure charts. What's going to happen today? What's my roadmap telling me for today on the 60-minute cloud, and what am I getting on the 1-minute targets? And if it all lines up, then we'll have a strong conviction. And we use this traffic light system where if it all lines up and it's all looking like we've got upside targets and we're above the cloud, that's bullish, we go green. If I've got conflicting signals, downside targets, and they're counter trend, or if the picture's not clear, then I'm just neutral, and that happens a lot. And then if it's all looking really terrible, we're below the cloud and downside targets, then I'm bearish. And so those are the daily reports. And then we do special reports where big events, so we did one on power. We could do this on anything, really. And on the special events, if something really dramatic happens, like we break a key level, or the trend has changed or whatever, then I use all the time frames and I give what's going to happen short term, medium term, and long term. And so each page, so my monthly report, I cover about 100 different instruments. There's 4 charts per instrument, weekly, daily, 1%, 0.5%, and I've got this this is how you interpret it. It's quite a lot to take in, but once you get good at it, you start to understand what the charts are saying. So in this instance, for example, we're breaking higher on the weekly. We've just broken into bullish territory long term. We've already been bullish on the daily for a while. And that happens, the shorter term trends will turn first, obviously. So we've now moved into short term, we've been bullish, we're now weekly bullish, and we've got upside targets. Notice we've got more upside targets on that bottom chart, no downside targets. And one of those downside targets on the top right chart is not activated. And so it's all starting to look more bullish, and that's why we've gone green. I can't even read what it is. It was the dollar, and that was back at the start of the year. This is another gem, by the way. So what I found myself doing is, because markets have been, pretty much a one-way bet for the last, couple of decades, just buy and hold, mostly. Markets have gone up, especially stocks. And I found myself going back to my textbooks. I've got tons of them. If any of you watch charts today, I've got a wall of textbooks. And I've been going back to my textbooks, many of them written in the 70s and 80s. And I found this diagram. I can't now remember what book it was in, but I found this diagram and I found it really interesting. And this is really what's happening in terms of the big picture. So I like this, how true it is, but I'm sticking to it. So in the old world, back before we had the death of inflation, in the old world, the cycles were, and these are big cycles, we're talking decades, bonds would fall first. So bond prices would fall first, and that means obviously that yields would go up, interest rates would go up. Then following that, sometime later, stocks would start to top and start to fall away. Economic activity would then to really start to slow when we That's obviously a harder chart to measure. You could probably use a GDP chart if you wanted. Whilst this is all happening, commodities are still going higher and higher and higher. And then last of all, precious metals would really get going when everything starts to get really bad. And so it's quite interesting because everyone's, why aren't precious metals now? Why is gold not rocketing yet? With everything we're hearing, well, it's just not started yet because of the cycle. But it probably will happen, but we've got to wait. So that's an idealized diagram. These are quarterly charts. The green one is bonds, and this was actually last quarter, so it's changed even more. So the green one was bonds. So this is a quarterly moving average of bond prices. This is the US 10-year. And the red one is stocks, and actually that's now made a lower low than that little dip at the end there. It's now made a lower low on the S&P 500. So that's the brown one. The red one is precious metals, what I'm talking about. So the brown one is now falling behind the green one. And commodities, that's actually the oil price has come back a bit and is flatlining, but the long-term trend in commodities is still pretty bullish. So you can see how it's all very well drawing the cycles, but when you actually look at the charts, it's a bit harder to see them. But it is happening. So this is my global market out report. I actually wrote this. Where did I write this? I think I wrote this on the weekend somewhere. I think I might have been in Asia somewhere. Basically, not much has changed. On the currencies, and this is not much has changed because this is a monthly long-term report. So the only change that we saw in currencies was that the dollar finally won against the Swiss franc. Last month, it actually finally won against the Chinese currency. So you will get changes, but in terms of currencies, the picture is unchanged. We put in italics our high conviction, where it's really clear, and the US dollar has been in italics all year. I might be changing that soon. Maybe the dollar is going to reach a point where it just cannot go anymore. Bitcoin, it's game over for crypto. I'm sorry for the speakers who are speaking about crypto. But basically, and the Aussie dollar is quoted in reverse, so that was looking quite neutral, but of course the US dollar has won against the Aussie as well, so that the Aussie is looking a bit more bearish. In terms of bonds, no changes here. We'll look at some bond charts, but they're all going lower. So basically the red ones are the bond price and the green ones are the bond yields, and they're all going lower. I've got in italics Italy. That looks terrible. The crisis in Europe will probably be Italy, biggest bond market in the world. And then looking at stocks, it's pretty bearish. And it's not me saying this, it's just what the clouds and the point and figure targets are saying. It's not me. Honestly, it's not my view. It's just what the charts say. So the UK stock market's held up partly because we've got big denomination of oil majors in the UK. The Indian stock market is holding up too, but it's hard to see how these markets will buck the trend. The VIX volatility has been rising above 30. The fear index is fearful. Tech looks terrible, absolutely terrible. Remember 130 for Apple? 130 is the price. We fall through there, that's bad. Facebook Meta looks just dire. It's met downside targets and going even lower. So all the tech looks pretty bad. Energy, I was expecting to be saying this is changing, but actually when I looked at the charts, and that's why it's really good not to carry too much expectation in your head. When you come to look at the charts, you do the analysis, then you make decisions. Brent crude, I just did change to neutral. We're just hanging around below $100 just for a bit too long, but it's not bearish. And carbon prices and power prices are starting to come back in Europe. They're coming back to a base trend. So the long-term trend is still probably bullish, but the medium term, we're starting to look more bearish because we're pulling back to a base trend. Base metals, that has been changing. We saw tin change this month. And so that has changed. The big ones, cobalt and lithium, they're not very liquid, but the charts look amazing. And then gold has just turned bearish even though we've just recently had a pop-up in gold back above $1,700. So I might be going back to neutral at some point, but for the moment, we are still looking bearish. We'll look at the charts. And soft commodities, grains. So most of these soft commodities, staples that the world depends on, are still in big uptrends. So that's going to have implications for the world. We're seeing some changes in some things like soybeans, lumber, cotton, hogs, but on the whole, staple food derivative charts are looking bad, and shipping rates at last are starting to fall. The dry bulk freight rate found support at 1,000, so anyone who watches shipping between $1,000 and $2,000 looks like the new sort of level that we're going to trade in. So here's the Aussie dollar. So on the weekly, what are we? We're bearish. We're below the cloud, and we're making new lows. And put the level in there. Don't forget the Dow theory. You know, the fact that we're making new lows, that's bearish. We've been bearish on the daily chart for longer because that turned first, but now the trends are lining up. So the Aussie dollar is looking bearish against the US dollar. We've got downside targets. I don't want to depress you too much, but 57, 59, 54. By the way, I'm willing to bet anyone that the first target will be met before the lower one. So you always look to the first target. Don't get too excited about the bigger downside targets, the first target. But we've got 3 selling moves on this 1% scale that are telling us that we're going lower. And they're all activated because we've gone below the level at the bottom of the column. And here we are on the short term. So we do have a couple of upside targets, counter trend, but I cannot be anything but bearish on this chart on that time frame. China, I talked about this, so I think this has really quite big implications for what's going on in China. There's a lot of worrying developments occurring in China. You guys are much closer to it here than we are in Europe, but basically the Chinese currency is now falling, having put in valiant attempts to hold. It's now falling against the dollar, and so that could be inflationary for China. I mean, I know it tends to export more than it imports, but it's still got to buy nearly all its raw materials in dollars. I would say nearly all, because it does produce some things itself. But this is going to have implications for inflation, because Chinese goods that we all buy are going to probably become more expensive as well. So this is a bond market chart. This is the US bond going back to 1985. And you don't need to be a technical analyst to know that that is a trend that has come to an end. This is huge. Remember that cycles chart? Bonds are going much lower. And again, you don't need to be a technical analyst to look at that and go, is it going to find support here or here? It's going to start a whole new trend and take ages, and there'll be times where it recovers and everyone goes, oh, I told you that was the bottom, and then it falls again and it goes through that bottom and everyone goes, oh, well, that wasn't the bottom, was it? So we are in a new trend. Some things to note here: we didn't make it to the top of the trend, so we kind of exhausted, and then we broke through the trend level, but the really big one is we're now at a lower low, and this was on the 14th of September. I can tell you this chart looks even worse now. So if you don't like my hypothesis that the bond cycle has ended, I can't do anything more to persuade you, I'm afraid. But that is what's happening. It's the beginning of the long-term trend. And I don't want to be it's what the charts say, it's not me. But the reality is, we see a top in the yield on the Aussie 10-year bond. You see a top in the yield and it pulls back and you go, oh, I knew that was the top. But we all know as technical analysts it's probably going to break that high and go higher. And we pull back to the cloud. Notice the price did come through, but the lagging line is finding support on the cloud. And we've got upside targets. So we've got yields at 4.4%, 5.4%, 4.5%. So I'm hazarding a guess that 3.6 is just, we're not even near the top. So interest rates are going higher. This is the Aussie stock market. I've tried to do quite a lot of Aussie because I'm guessing that most people in the audience are more interested in what's happening in Australia. So the Aussie market's held up better. This is on the 2nd of September, but that's that level of 6,500 on the ASX 200. That's what we've got to watch. If we go lower than that, that's not great, but we are starting to wander through the cloud. The lower high, we haven't quite yet had the lower low. We've been below on the daily. Notice how the cloud, we found the lagging line sort of hit the cloud, but then fell away. We did have an upside target, but now we've got this downside target to 5.9, and that's 13% lower. We've got downside target here that was passed, another one that was kind of met, that's bearish confirmation. And we've got a new downside target that's not yet activated, but if we get to a new low, that's 5,000 from 6.5. That's just the beginning, because we're going to get new targets generated as the trend develops. The lucky country has held up better, but I'm afraid even for Australia and India to buck the trend, and remember, bonds fall first, then stocks. Stock markets are going to go through that turmoil. So the Indian market, I'm just waiting for a break of 60,000 to activate this new upside target, and that one wasn't activated either. So I've got two upside targets that are not activated with a new high, but the Indian market, you kind of think if it could get higher, then that might buck the trend, but the reality is it just can't get above those levels, and we're seeing, it's above the clouds still, but we're just starting to see after a long trend, it's just starting to roll over. So it's not yet bearish, hence we're neutral, but the reality is that's probably going to crack as well. The world's most important stock, that's Warren Buffett standing there in the middle, or sitting there with his hands. Warren Buffett, I did an analysis of his portfolio the other day. He's clearly not a technical analyst, but I'm not poo-pooing Warren Buffett, but his biggest holding is Apple, by a mile. Apple is his biggest holding in his portfolio, Berkshire's holdings. And if Apple falls through 130, that was the June low, then it's the best looking tech stock at the moment, obviously the biggest stock in the world. So I say to people, you only really need to watch one stock as to what's happening in global markets. It's Apple, and we've got downside targets, 9% lower, 10% lower, 12% lower, an upside target that's not activated at a lower high. Got another one here that's 11% lower. Three targets all pointing to 10% lower, all below that 130 level. And so we'll hear in the news, Apple stock falling. There'll be a reason why. You'll be reading how they've got problem here, or Chinese production, or they can't get chips, or there'll be a reason. We all know there'll be a reason. But the reality is the chart is telling us something's not right. Crude oil has been a bit of a harder call. It's fallen back below this 100 level, and so I'm bearish on the medium term, and I'm neutral on the long term. The lagging line is still a long way from the cloud. I've got mixed targets. When crude was at 90, I gave a target to 150. It only went to 140, so that's kind of bearish. It didn't quite get there. So that just tells us that we're probably going to end up trading a range in crude. We've got some downside targets there as well. Coal, energy's dirty little secret. Coal prices have just gone through the roof. Everyone will tell me that's because they need coal because they can't get gas to generate electricity. Yeah, I know. But coal prices have been going higher. And the targets, we had two targets pointing here. I do look at Newcastle. This is actually API2, which is the European benchmark. But basically, we had targets in 287, and the charts are very similar. And two targets pointing to the same level and passed. So that's still going higher, but of course that's contrary to a lot of people's carbon. So you're going to say to me, well, thanks for cheering us up, David, but where are this conference is meant to be about where are the opportunities? And I guess the key message is there aren't going to be many. So just looking at the other day. I had quite a lot of cash in my portfolio because I've been selling a lot, and I thought, well, how do I make this work for me? So I started looking at uranium stocks, and it's not wrong to have a hunch. So I know, for example, that Japan reversed their decision on nuclear. Germany's probably going to do the same. France has been having problems getting plants working this. So I know these things. Read about them, and I go, okay. So how do I make money out of that? So equally, I've got lithium stocks because I think lithium looks amazing and the chart looks great. So then I just look at the stock charts and say I've got a list of lithium stocks. There's not many, and a couple of Aussie ones. And I go, right, which ones look better? Which chart looks best? And how do I look at that hunch, but then use the charts to go with that hunch? And so I did this the other day. Uranium. I've probably been too eager, too early. But part of the problem with these stocks is they're so illiquid that they just can jump 20%. So if you wait for the breakout, but the trends are still up. The stocks look great. And when I work with clients, I say, well, if we're above the cloud on the weekly and we're above the cloud on the daily, I'm just relatively happy. Just find me stocks that are above the daily and the weekly cloud, for God's sake. It's not that difficult. And then they give me a great big list. I had a client who gave me the list. I looked at day before yesterday. I'm a bit lost on where I am in the week, but I looked at the day before yesterday. It gave me a list of about 200 stocks, and literally, I could find out of silver I could find one, out of gold I could find two, and these were long lists, and out of uranium I found 10. So it just kind of told me something that this seems to be the stocks in this area seem to all be above their clouds. So it's not that complicated. So I actually did buy 3 Aussie and 2 American and 2 Canadian and 1 American uranium stock. Just put a little bit of money in each one, compared to just take the risk and a bit of a punt. But the clouds look fine. So if I'm above the clouds, I'm happy. It's sunny. So for the gold bulls, basically, gold is really not doing what you'd hope it would do. If you're a gold bull, you're going, I just don't understand why gold isn't rocketing. And the answer to that, and this is one of the funds I work with, is a precious metals fund. And they're just, we started out with 100 holdings, and I think we're down to 30. And they said, you've got to be kidding me. And I said, yeah, but we did an analysis. And by the way, in terms of being right with the strategy, it's wrong about 20% of the time. So in fact, we found about 18% of stocks that I told them to sell were higher. But 82% of the stocks that I told them to sell were now lower, and quite a bit lower in many cases. So we went from holding 100 stocks down to, they've gone to holding now 30. And I basically just said, these might all be great because they're fundamentalists, trying to reason with them, it probably would be easier to reason with a terrorist with a machine gun, to be honest. But basically they are, really wedded to their fundamentals. And I've just said, well, all I can tell you is what the charts are saying. If we're below the cloud on the weekly and we're below the cloud on the daily, I really cannot tell you that this is in an uptrend. I just want you to hold stocks that are going up, not stocks that are going down. And remember the way that cloud is constructed, it's just a derivative of the price. If we're below the cloud, it's just telling you that the price is falling on itself. It's falling on an average of itself. So what's interesting in precious metals is, I think gold, and so also we've been watching silver inventories, and silver had its biggest one-day rise a few days ago. I think its biggest rise since 2008. So silver inventories are going to levels which are just, there's going to be a squeeze. So it is going to happen, but where do I want to buy gold and silver? Well, ultimately, I want the clouds on the stocks to be in bullish territory, and they might lose out on the first 20%. But when gold does break 2,000, and we know from those cycles that it will break 2,000, probably, but we have to wait. So, I think the big message for gold bulls and precious metals is just got to be patient. It's going to happen, but don't give the first bit to the market. Just let it happen and then get in, but we are going to see. We're seeing palladium prices already finding support and rising. And I cover this daily. I recorded one yesterday in my hotel room. I cover all of these things every day, so using the chart matrix. So for the moment, and gold did actually dip below this line. It went below 1700, nudged the low 1600s, has got back. So maybe that is the bottom, but I still feel it's a bit risky. So it will be a thing, but you just got to be patient. And we've still got these big upside targets. We do have a little downside target. I think what is likely to happen is we will pull back. We won't make it to 1427, which is the downside target. And the fact we don't make it to that target, we're also right on the trend support on the point and figure. The fact we don't make it to that target is probably, then telling us it's bullish confirmation. People are willing to buy this stuff at these levels. So I do think there's going to be an opportunity, but there are not many at the moment. I mean, it's things like uranium, lithium, and you're in a great country for stocks in these kind of sectors. They're there, but it's going to be harder. So in summary, and I said I would provide you a technical analysis roadmap for the months and years ahead. So the roadmap is bonds are going to plummet, interest rates or yields are going to go up, stocks will then follow. So I'm afraid it's going to be really hard to make money in stocks in the coming years, and you're going to have to be really picky. Doesn't hurt. I mean, one of the fund I was talking to, the gold fund, I mean, they're more than 50% cash at the moment, just waiting. And they said, can we come up with a shorter term trading strategy to try and trade this? I said, no. You for what your remit is, you're just going to have to, zero performance is better than what you're going to see if you're invested. So basically, stocks will fall, and quite possibly back to the 2008-9 lows. So, really, that's a long way. And if you think about it, what's happened in bond markets, quantitative easing, governments buying bonds. We averted the crisis in 2008, 2009 by intervening. The banks all intervened to avert that crisis. They've got less tools in the toolbox to do it this time around. And basically bond markets are already cracking, and it's going to be a major issue in places like Europe. I mean, Italy and Germany are going to be very, disposed in different ways, and so I'm seeing interest rates in Italy at 12%. I'm seeing bond yields at 12%. I'm seeing bond yields in the US, if we make new highs, at 9.5%, 10%. So you just think about what that means. I mean, that then has a follow through to equities, because if you can get 10% on your money in cash, how comfortable are you going to be invested in stocks? So it's going to be pretty bloody, I'm afraid. And then we'll see economic crises. We're seeing Sri Lanka having massive issues because they don't have enough dollars. We're seeing currencies because of the US dollar. I do think the US dollar, by the way, will top at some point. I'll know it when I see it. Remember, I've got to see it retrospectively. But I do think this has been the year of the dollar, and I think it'll then just go into a big range, and it can't go on forever. It'll probably just, but it will stay at relatively high levels historically. Italy, I think, is a black swan waiting to happen in Europe. I'm just seeing things there. The UK, any of you are following the UK, we've had an absolute political disaster this last couple of weeks. Well, the irony is that the news is what you hear, but the pound is actually higher than it was when that was announced. So, call it what you want. But the news will tell you one thing, but actually sterling is actually at a higher level than pre that budget. So, but the media love it. So don't listen to the news too much. But, the fact is, these sorts of crises that you'll read about and hear about are all reinforcing. Remember, news follows price. The fact is that sterling's been falling long term. We've got targets to parity on the dollar. It's been falling long term for ages. Lots of things. This is not a UK problem. This is a global problem. Interest rates in the US. They talk about mortgage rates in the UK at 6%. Well, they're already there in the US. This is a global problem. This is not something that's just happening in the UK. It's just that the UK media are ferocious. So basically, you've got to see a lot more of these kinds of crises breaking out around the world. And so that's the economic activity. Commodities are in an uptrend. I've gone orange here. They probably still have further to run, especially foods and grains and things like that. The charts all still look very bullish. It's great for Oz because there's more commodity stocks. So, the one message to Australian investors is just, follow your commodities. And then the dollar, that's a big factor for commodities. So if the dollar does start to flatten or fall, then of course, there is a symbiotic relationship. The dollar goes down, commodities go up. And I think this is actually really what's held precious metals back, is that rising US dollar. Because, precious metals are priced in dollars. So once dollar stabilizes or starts to come back a bit, then we might see that move in precious metals getting going. Think about global trends, so electric vehicles, lithium, cobalt, foods. But do watch, because you get a sell everything mentality. So I've noticed with some of my Aussie stocks, my lithium and uranium stocks, if the Aussie market's down, then they're down, but down not by as much. And then, on the day when the Aussie market was up 3.5%, this massive move, counter trend move, by the way, don't get too excited. Then, basically, and you do get big counter trend moves. So that's quite key. And then precious metals will get going at some point, but wait for the break and watch those key levels. So the opportunities will be few and far between, but the good news is that there will be some. So good luck. It happens in uptrends, especially if you're a bull. And this is how you can contact me. There's my email. For those that are watching online, you can just email me a question if you want. You can follow me on chartstoday.com. I do a daily video there. And Twitter, and on LinkedIn, I've got about 24,000 followers. Just look me up on LinkedIn. And I think, Max, I've got 26 seconds left. Thank you.